Hey, what is going on, everybody? Welcome back to the channel all about real estate. My name is Lewis, and today's video is gonna be crazy. We are gonna be talking about an article that I found that talks about the continued amount of mortgage layoffs that we are seeing in the market and how that actually impacts the economy. Now, this is gonna be a short video clip here today, but I thought the information was really interesting. And a lot of times what I've seen in the past with mortgage and real estate is they tend to have a leading and lagging indicator, which we will talk about here towards the end of the video. So if you are new to the channel, please consider liking and hitting that subscribe button right there and leaving a comment. Your comments really help me learn and grow, and they also help others learn and grow. We would love to hear from you. So without further ado, let's jump right into this article. Okay, so we're gonna go ahead and go through this article relatively quickly. It's from The Truth About Mortgage, and it says that there is a long list of mortgage layoffs, mergers, and closures, and it's updated as of May 9th. I'll link to it in the show notes. It says, even though it's been roughly a decade since the downturn began, mortgage companies are still facing consequences of getting involved in what was then a very risky housing market. Amazingly, we continue to see layoffs and closures driven by what transpired many years ago. Given how bad things got, this isn't too surprising. Recently, mortgage layoffs have been driven by major decrease in refinance demand and a dwindling pool of eligible home buyers thanks to significantly higher mortgage rates. So we've seen this basically across the board. Mortgage rates have gone up. The refinance game is over. I mean, the only reason somebody really refinances is to lower their rate and lower their monthly payment. Now, in some cases, people want to do debt consolidation or take a little bit of cash out, but let's say that they refied into something in the threes or even the high twos a year ago, and even now that they have record amounts of equity, they may want access to that capital, but if you have to restructure all of the debt at 5.5%, your payment is going to jump up substantially from where you are today, and it's basically deterring many of those would-be candidates for refinance. Now, the article goes on here saying that, simply put, mortgage companies must right size as too many players chase far too few loans. So you have all these mortgage loan originators that were, let's say, in call centers or working for large banks. And when the refinance demand dries up, you still have all these LOs, and they are fighting over fewer and fewer clients trying to capture that business. Now, what happens is eventually that model breaks. They start shaving the bottom 30%, the ones that were not producing, and then it increases from there as there's less and less demand. And as we go through this list that was updated recently, I mean, take a look at some of the big players on this list. So it says that Guaranteed Rate had layoffs. Now that's per user comments. Loan Steady layoffs. Costco mortgage program is no longer available as of May 1st. For those of you who don't know, Costco didn't necessarily provide their own mortgage company, but they did have mortgage companies that partnered with them, and they offered special rates and special pricing. Well, if they are no longer providing that product, it means that those lenders that were participating in these programs do not have an appetite for discounting or cutting their margin or paying a fee back to Costco. So I thought that was really interesting. US Bank here, cutting 200 mortgage operations jobs. PennyMac, this is one of the top 10 mortgage lenders and servicers. 45 jobs out of Pasadena. I think they were on this list a couple times. So Mr. Cooper, that is a large mortgage servicer, 250 jobs. Rocket Mortgage, huge mortgage company. They looks like they didn't lay anyone off, but they offered buyouts to 8% of staff. And if you continue to go down here, there are some really big players. Look at this. PennyMac cut 227 jobs in Aurora, Moore Park, and Westlake, California. I believe that was their headquarters. And another 81 jobs in Roseville, California. Oh, Better Mortgage. They are a big player. They cut roughly 900 jobs. That's about 9% of their staff. They were all over the news here. And the list goes on and on and on. If you want to read through it yourself, you certainly can. But you can see as I'm just scrolling, I mean, there is a list of mortgage layoffs, and there's some mergers and things like that that are taking place. How do these mortgage layoffs actually impact the economy? Well, what I have personally seen in the past, it is a leading indicator as we're going into maybe tougher or tighter times. And once you start to kind of think through what a mortgage company does and the value they provide to their borrowers, it starts to make a lot of sense. As an example, most people look to refinance because they need to reduce their rate and lower their payment. Now, lowering their payment by a couple $100s per month creates more disposable income. And when people have more disposable income, they can go out and actually spend more in the broad economy there. So they're going to be able to have more income to go and support local businesses and big businesses and buy fuel and travel and do all sorts of things, which really helps stimulate the economy. The other thing is when people refinance and pull cash out of the property, now they have a lump sum which they're able to take and put back into the economy in some way, shape, or form. Whether that's renovating their house, they're supporting contractors, they're supporting vendors, cabinetry companies, tile, granite. All of these things cost money. All of these things support the economy. And every single transaction that is done supports a title company, it supports a notary, it supports real estate agents, loan officers. I mean, there are so many industries that are really impacted by real estate. If we start seeing less and less people employed in the mortgage business, it is likely that we might be going into a little bit of tighter times. That's probably not a big surprise. The last report on GDP was negative for last quarter. If we see 2 negative quarters, that is technically considered a recession. So this is not meant to be a doom and gloom video. It's just meant to bring your awareness to it so that you can start planning accordingly. Anyway, hope you found the information useful and found some value in it. If you haven't done so, please consider liking and subscribing. We'll see you on the next video.